Hey everyone! If you're serious about understanding the stock market, you've got to have the right tools in your toolkit. And today, we're grabbing one of the most essential ones out there, the price-to-earnings ratio. Let's dig in and see how this thing really works.
So let me just start with a simple question for you. Imagine you've got two stocks in front of you. One's trading at $500 a share, and the other one is just $10. Just based on that price, which one's the better deal? I mean, it seems pretty obvious, doesn't it? But here's the thing. That price tag can be so misleading. The real secret to finding a stock's value isn't in the price at all. It's actually hidden inside a powerful little ratio. And this brings us to what I like to call the price versus value puzzle. You got to think of a stock's price as just one clue in a bigger mystery. Our job, as investors, is to use a special tool to figure out what that stock is actually worth. At its very heart, this tool we're talking about answers a really simple question. How much money are other investors willing to spend to get their hands on just $1 of a company's profit?
So let's decode that tool. It's called the price-to-earnings ratio, or just PE for short. And you can think of it like a detective's magnifying glass for stocks. It helps us look right past that shiny sticker price to see what's really going on underneath.
Okay, so here's the textbook definition. The PE ratio takes a company's current share price and compares it to its earnings per share, or EPS. And all EPS is the company's total profit divided by all its shares. So at the end of the day, it's just a straight-up comparison of what a share costs you versus what that share is earning.
And the calculation? It's just as simple. You find the stock price, you find the earnings per share, and then you just divide the price by the earnings. That's it. Price divided by earnings. Super straightforward.
So you do the math and you get a number. What does that number actually mean? Well, if a stock has a PE of 20, it literally means that for every single dollar of profit the company makes, investors are willing to pay $20. It's a direct measure of what the market is thinking and feeling about that stock.
But, it gets a little more interesting here. There are two main flavors of PE. One is based on past performance, kind of like a detective looking through old case files. The other is based on future predictions, like following up on a hot new lead. Think of it like two sides of the same coin. On one side, you've got the trailing PE. This one uses the real, actual, reported earnings from the past year. It's solid, it's factual, it's history. Then you flip the coin over and you've got the forward PE. This uses analysts' predictions of what the earnings are going to be over the next year. It's all about the future, but it's also just an estimate, and estimates can be wrong. So a smart investor, just like a good detective, uses both of these. You use the trailing PE to understand the company's proven history, and you use the forward PE to get a sense of what the market thinks is coming next. Okay, that's enough theory. Let's put this tool to work and see what happens in a real-world scenario. We're going to compare two companies in the exact same business and see what their PE ratios are telling us. Let's take a look at two players in the energy sector, Marathon Petroleum and Hess Midstream. Right away, you can see Marathon's stock price is way higher, over $160. After you do the math, that gives it a PE ratio of about 23.4. Hess, on the other hand, has a much lower stock price, and its PE comes in at around 15.5. And when you chart it out like this, the difference really pops. At over 23, you're paying a much higher premium for every dollar of Marathon's earnings compared to Hess's. It's not even close. So this brings us to the big question, the kind of question an analyst would ask. Seeing this, is Marathon just overvalued? Is it just too expensive compared to its competitor? Or, and this part is absolutely critical, does that higher PE actually mean something else? Maybe it means investors are willing to pay that premium today because they believe the company's profits are about to explode tomorrow. In other words, they expect Marathon's earnings to grow way faster than Hess's. A lot of times, high PE is really just a sign of high expectations. And that leads us to our final, and maybe our most important section. The PE ratio is an amazing tool. It really is. But even the best detectives know the limits of their tools. You have to know the warning signs. So here are a few critical rules to keep in your back pocket. First, only compare PE ratios for companies in the same industry. What's considered high for a tech company might be totally low for an energy company. Second, if a company isn't making any money, it doesn't have a PE. It's just not applicable. You can't divide by zero. Also, be really careful because things like a mountain of debt can distort the numbers. And of course, all of this assumes the company's reporting its earnings accurately.
And here is the main takeaway, the one thing you should remember if you forget everything else.
The PE ratio is a powerful starting point for your investigation. It helps you ask the right questions, but it is never, ever the final answer.
The bottom line is really this. No single number can tell you the whole story. A smart investor builds a complete case. They use a whole variety of financial tools before they make a decision. And the PE ratio is just one very important piece of that puzzle.
So there you have it. Now you have the tool. You know how it works, and you know its limits. The only question left is, what hidden value are you going to go out there and uncover?